What do you consider as your assets? An accountant might give you a standard answer, but let's delve into a different perspective. You see, an accountant will probably tell you that an asset is something of monetary value that you own. This could be anything, from your alarm clock, your everyday dishes, to your stock shares, personal residence, and even your car. However, these aren't really assets. Why, you may ask? Because an asset is something that puts money in your pocket, whether you're working for it or not. So, all those items that we often consider assets don't have any value until the day you sell them. With this new understanding, let's move on to the asset column of your personal financial statement. It's time to see what truly counts as an asset in your life. The asset column in your personal financial statement is divided into 3 distinct sections. Let's dive deeper into each of these sections to understand them better. First up, we have investments. This section is home to all your financial investments. It includes everything from the cash you have on hand, the money in your traditional bank accounts, to your paper assets. When we talk about paper assets, we're referring to things like stocks, bonds, and mutual funds. Essentially, these are all the assets that can be converted into cash. Moving on, the next section in our asset column is passive income. Now, this might be a term you've come across in the first module of this course. In the context of your financial statement, passive income refers to the monthly cash flow and the total value of the asset that generates this cash flow. It's the money that comes in without you having to put in regular work. This could be income from rental properties, dividends from stocks, or royalties from a book you've written. The key here is that these assets keep adding to your wealth, whether you're working, sleeping, or vacationing in the Caribbean. Finally, we come to the last section of the asset column, the one we call doodads. These are items that you generally think of as assets. Your home, your car, your jewelry, and your furniture all fall into this category. But here's the catch. According to the definition we're using, doodads aren't true assets. Why? Because they take money out of your pocket instead of putting it in. Sure, your house might be worth a lot of money, but until the day you sell it, it's not making you any richer. In fact, it's probably costing you money in maintenance, taxes, and mortgage payments. So as we wrap up our exploration of the asset column, here's a little food for thought. As you can see, not all assets are created equal. It's not just about what you own, but also about how what you own impacts your financial health. Now that we've examined the asset column, let's summarize what we've learned about assets, liabilities, and doodads. Assets, as traditionally defined, are things of monetary value owned by an individual or a company. This could be anything from your stock shares to your personal residence. However, an asset is something that puts money in your pocket, whether you work for it or not. Then we have liabilities. These are the obligations you owe. They're the debts that drain your resources and take money out of your pocket. Lastly, doodads. While they might seem like assets, your car, your home, your fancy watch, according to Rich Dad, they're not. Why? Because they take money out of your pocket without generating any income. So, in essence, the difference between assets and doodads boils down to one thing: whether they put money in your pocket or take it out. Remember, it's not just about what you own, but what those possessions do for your financial health. Stay tuned for more insights into understanding your financial statement.